Hi and welcome to this week's Property Insider video. Today Dr. Andrew Wilson and I discuss some of the budget initiatives as they relate to property, as well as some of the other important market facts that came up over the week. If you want to keep up to date with what's going on in our property markets, why not subscribe to this YouTube channel and click the little bell icon so that you'll be informed each time a new show comes out. This time last year, we were supposed to have a federal budget. Instead, we had a pandemic, and over the year, many elements of our life were upended due to COVID-19. Around this time last year, our Prime Minister Scott Morrison said he'd build a bridge for us to get to the other side. And it seems he did. The government threw everything it could, including billions of dollars, at creating jobs and keeping our economy moving. And it succeeded. And it's still going to do that if you look at the federal budget handed down by Treasurer Josh Frydenberg this week. In fact, you'd think it's raining money. Never before has a budget done so much to supercharge the economy after the worst of a recession has passed. But the underlying message I got from the pandemic budget is that while our recovery is running apace, the economy's still fragile and it remains unable to stand on its own 2 feet. So the government's got no option but to continue spending, and it's given the green light to a number of initiatives to ensure our economic recovery continues. We learned that taxes on company profits and personal income taxes are driving a revenue bonanza for the government. So what kind of treasurer could resist spending some of that, given the ultra-cheap borrowing costs? And, let's be cynical, an election campaign expected within the next year or so. So in today's Property Insider video, I want to have a chat with Dr. Andrew Wilson, Australia's leading housing economist, about some of the impacts of the budget on our property market, as well as some of the important economic data that's been released over the last week as it relates to property. Welcome, Andrew.
Yes, good morning, Michael, with our post-budget reading of the tea leaves, and quite an interesting budget, but I don't think there are any great surprises, really, not just for property, but also generally. We're in spending mode and we'll continue to do that, and so we should.
Well, interestingly, most of the information was leaked well beforehand.
Yeah,
but
right.
Before we discuss the budget, because there's a few things I think worth mentioning, let's quickly discuss the auction clearance rates. And we did actually find that even though it was the second busiest auction weekend for the year, auction clearance remained very strong, didn't they?
Yeah, I think there was some important signs from auction results last Saturday, Michael, and it is worth discussing. We actually had the biggest May day in our auction history on Saturday. So it was the biggest day for May auctions, and there were record days, obviously, in Melbourne and Sydney, and that's what made it an overall very strong weekend, and good numbers in Brisbane as well. But it really does show that there's still a considerable appetite from sellers to engage in the market. Why wouldn't they? Strong competition remains amongst buyers. Prices are continuing to rise strongly. And we saw that, again, that competition with, although we had a record day for auctions, clearance rates were still in those boom time levels. Sydney's just eased a little bit from those clearly unsustainable 90% results over March, but the mid-80s a year ago would have been looked at as extraordinary results. And Melbourne's actually picked up a little bit, Michael, over the last month, with auction clearance rates consistently over 80% now. And that seller data was reinforced with the National New Listings Index for the week ending Sunday, which showed a rise nationally of 4.5% in the number of new properties listed for sale over the week ending Sunday, May the 9th. And again, that reinforced that there's still that very strong underlying appetite to engage the market. And of course, we know most buyers are sellers and sellers are buyers. So what we see in terms of increased seller activity, we will see with increased buyer activity. And this isn't a rush to market from sellers. It's just an engagement in a very, very strong housing market.
Andrew, with regard to the budget, we know that booming iron ore exports have delivered a bumper company tax take over the March quarter, with the budget's bottom line improving by about $30 billion since the mid-year economic and fiscal outlook in December. And our economic recovery is likely to continue, underpinned by strong household spending, supported by a further lift in restrictions, increasing confidence as uncertainty disappears, not just locally but in the world. While almost everyone seemed to win when you look at this year's budget, some of the property-related initiatives in the budget really aren't going to make such an impact. It looks like almost everyone's a winner in the budget if you read the media, but your thoughts were a little bit different on that, Andrew.
Well, look, the big picture is certainly positive, Michael, and that is downward pressure on unemployment, jobs growth, more people getting back into the workforce, incomes rising, albeit modestly, but an income is better to have than none at all. And that builds, as you said, into confidence. And the prospects going forward are still very positive for Australia. And that works its way through all sectors, and particularly, of course, the housing market. But I think that what was presented wasn't exactly out of left field. We are, Australia, in a very strong position relative to the debt levels in other countries. And, a lot of that is, as you mentioned, is because we're fortunate to have a strong export sector, which has been driven by record iron ore prices, which has certainly helped our bottom line. And it means there's more money to spend, and we're spending it. And so we should. We're still a long, long way away from where we should be in terms of perhaps an acceptable economic environment. We're still not back to pre-COVID, and you've got to understand that we were still busily cutting interest rates prior to COVID because our policymakers weren't happy with the way things were going. So we'll get back to the pre-COVID environment, and then we'll start working on the underlying structural issues that have been a problem really for the past decade, not just in Australia, but most advanced economies. But we can talk about some specific policies that were introduced or revamped in terms of the housing market, Michael, if you like.
So let's first have a talk about the downsizers. In the budget, Australians over the age of 60 who downsize their family home are going to be rewarded, well, that's the word the budget used, by being able to contribute $600,000 as a couple or $300,000 as a person to their superannuation. Now, this scheme was previously only available to people over the age of 65. And the thought process is that it's going to free up more housing stock for younger families. My question is, what are these people going to do? Where are they going to move to? There isn't enough of the right accommodation. And if they do find big family-friendly apartments or townhouses, they're not going to have much change left over. And then my other thought is, do the young people who now need to get into the property market really want some of these older houses?
Well, this policy was introduced in the 2017-18 budget, Michael. I think its results have been clearly underwhelming. There's certainly been a number of people who've taken advantage of it, but whether they were just taking advantage of something they were going to do anyway, or whether they had accelerated their downsizing decision, I think is highly questionable. I think there hasn't certainly been an acceleration in downsizing or the freeing up of all these larger properties. But now, as you mentioned, the threshold has been dropped down to 60 from 65. There's been some cheering on from the media and some parts of the commentariat about this will be a great result. I think it's actually going to be even worse, because the big problem for the downsizer isn't necessarily the financial incentives, because most of them are, of course, well established in terms of their wealth profiles. I'm not saying they're wealthy, but they're certainly established to the point where they are thinking of selling the family home. But the problem that they have, Michael, is where do they go? Where do we go? Where is there an affordable medium density or larger, higher density property that we're happy to go and move into? And this has been the constraint, that even though the incentives are reasonable, there hasn't been the option to move. And you're not going to move from somewhere where you've been spending at least a decade in to somewhere where you're not 100% happy that it's going to suit you or for the next stage of your residential lifestyle. So, and I think that a person, when we move that age demographic downwards, it becomes even more important, because they are certainly more interested in a suburban locality rather than a regional retirement style locality for their downsizing decision. And we've undersupplied that part of the market, Michael. We just haven't been able to match the demand for medium density in those, middle ring and inner suburban locations. And that means it'll be, if anything, there'll be fewer downsizers interested until we get the product that makes them happy to move. So I think this is just a yawn.
I fully agree. Baby boomers are not heading for retirement villages anytime soon, are they?
No.
When you look at the other end of the spectrum, the younger people, there was a new initiative which is going to allow single parent families to purchase a home with as little as 2% deposit. Yes. But there was some confusion about that. No, the government's not giving you the balance of the deposit. They're guaranteeing, so to speak, the other 18% for the 20% deposit, but you've still got to be able to meet the serviceability criteria, Andrew.
Yeah, that's right, Michael. This is just a similar policy to the first home buyer deposit scheme, which allowed first home buyers purchase a property on a 5% deposit. But the point to that was that they still had to borrow 95% of the value of the house. It's just that the mortgage insurance component was paid by the federal government. Now, this is the same. You can borrow if you are a single parent and meet the income requirements. And the income requirement is that you are not earning more than $120,000 a year. So you can borrow, you can use a 2% deposit to purchase a house. Therefore, you have to pay the remaining 98% of the mortgage. So your repayments have to be high, or your income has to be high enough to cover those repayments. And the mortgage insurance is covered by the Commonwealth. But the issue there is if you are earning the maximum $120,000, it means you can borrow around about $500,000 on that income level. But the real issue, again, is a little similar to the downside. Is where do you go? This is directed at a family, Michael, a single income family. And they're obviously going to be, if they're a family, looking for more than one bedroom, I would hope. So that brings in, again, the need for a larger home for these people who are taking advantage of the policy. So that's at least a 2 or 3 bedroom unit. And units, particularly in the Sydney market, are certainly the most affordable option. And median prices for 2 and 3 bedroom units in Sydney are over $600,000 for a 2-bedroom unit and over $800,000 for a 3-bedroom unit, Michael. Now, it's a lot more affordable in Melbourne and Brisbane. The point is that it's still at the upper end of the income levels that you would require to purchase units, larger size units in Melbourne and Sydney. And if you're thinking of houses, well, unless you go right out to the fringe, the median price for a house in Sydney is nearly 1.3 million. And for a house in Melbourne, it's around 900,000. And, in Brisbane, it's pushing 600,000. So these are big numbers if you're looking for a house. So look, the problem is, Michael, where do they find somewhere that's suitable for their family that is affordable so they'll be able to take advantage of the policy? And the point is, these are big decisions also, Michael. So they'd be wanting to make sure that in terms of that family environment, that they're securing something for the longer term rather than somewhere which is just a stopgap measure, which is, even though renting obviously has its downsides in terms of wealth creation and security of tenure, etc., it still gives those families, single income families, some flexibility to move at some stage in the shorter term if their circumstances require it. So look, it's a good thing to bring more people, more first home buyers into the market. This will also be available for those that have previously owned a house, but have, for whatever reason, are no longer homeowners. But there are strict price limits, $700,000 in Sydney, $600,000 in Melbourne, and it's 10,000 places over 4 years. So look, it's welcome. It's more of a welfare relief policy for housing. And it will be interesting to see, with prices continuing to rise strongly, Michael, just how many of these potential first home buyers take advantage of the policy, Michael. But I think there's a little bit of politics at play here. And it is all about, as we know, there's a majority, statistics show us that the majority of those single households that are renting are females. And also, of course, we are going to see, and we're already seeing, falling first home buyer activity. So the government would like to be seen to be doing something about that now. Just how strong the numbers are remains to be seen. But I think there are the usual constraints in these policies, particularly in a red hot market where prices are rising strongly, and more particularly about the availability for a family-friendly property in locations where these particular participants would be wanting to live.
Much the same would apply to the extension of the new home guarantee. That's where the government gave you a guarantee for that 15% if you put 5% deposit down, rather than pay the mortgage insurance. It's only another 10,000 places. And again, I think the same restrictions with regard to where you're going to do it in the limits of what the scheme is going to be able to offer. But they also had another way. I mean, we like the idea that first homeowners are getting in the market, and a lot have, but they're also suggesting you can take more from your super contributions this time round too.
Yeah, look, just a couple of points. Firstly, on the home builder guarantee that they've reintroduced, Michael, and as you said, that allows you to purchase a new home or a newly built home with just 5% deposit, with the government guaranteeing the rest of the usually 20% deposit that you would require. Again, you have to be able to service the loan in terms of your income requirements. The income limits on that for couples 200, you've got to be under $200,000. The price ceilings to be eligible are a lot higher. They're nearly $1 million, the price ceiling in Sydney, for example, and that's appropriate because the median price for a new house in Sydney is over $800,000, nearly $900,000. So again, there are those restrictions of where to buy. I think this is a more reasonable policy in terms of its impact, Michael. It will continue to stimulate the building industry, which has been, particularly in some markets such as Perth, a significant driver of economic activity and jobs growth. That's a good thing. I am a little concerned, however, that this surge in new building, which is yet really to be felt on the ground, is going to result in supply constraints, particularly, and which will lead to higher prices for new home building costs. So that's putting upward pressure, as well as the demand side of the aspect is putting upward pressure on costs and therefore prices. And the other thing is, Michael, that what this does, of course, particularly in Sydney and Melbourne and Brisbane, is it pushes lifestyles more out to the fringe. We get that urban sprawl continuing. You know, there are issues about outer suburban dislocation and marginalisation as a result of pushing further and further outwards. And the level of infrastructure that is provided in these particular outer suburban areas is also problematic as well as issues such as the commute and those sort of bits and pieces. So even though it's a good thing for the economy, it's not really on the supply side, to be quite honest, looking in a much more rational and longer term sense of how we need to be managing suburban and urban environments. Now, the other one you mentioned was, of course, the contributions to super. Again, this is a policy that's been changed slightly, that you can now contribute up to $50,000 in your super fund. Now, the policy generally is this, that you can nominate certain funds to put into your super fund, that because you're putting them into your super fund, they're tax advantaged, but they have to be specifically nominated for a home deposit, and you can access them. It used to be up to $30,000. It's now up to $50,000. But of course, you've got to save $50,000, Michael, from your normal income. Now, yes, you get a significant tax advantage, but you've still got to save the $50,000. So, look, this is a longer term issue. The tax advantages aren't really a significant boost in the shorter term to your capacity to gather a deposit. And this doesn't come into play until the 1st of July 2022. The real issue with all these policies, Michael, is that at the end of the day, more demand only pushes up prices or costs for building, one or the other. And we really need more supply, not just for first home buyers, but also, as we were discussing before, for those downsizers, to be able to start getting a more rational and sustainable housing market. Because I think regardless of these initiatives, we're still going to see at best, I reckon, a 20% fall in first home buyer activity over the next 12 months. And that's if all those policies are taken up. If first home buyers take advantage to the maximum of those policies, and there's 10,000 for each of those first home buyer initiatives. And we know that investors are moving back into the market strongly, Michael, and that's only going to keep prices percolating, certainly not at the clearly unsustainable levels over the last 3 months. And by unsustainable, I mean we're not going to get any higher incomes or lower interest rates to keep fueling higher prices, but prices will still rise because demand is still quite strong, but not at the significant extraordinary rates that we've had this year so far. So supply side was ignored in the budget, and that's the real problem, I believe, in Australian housing markets. We're just not building enough property where people want to live.
So it's got to be the right property that we're building, and family-friendly apartments as opposed to ones built for overseas investors without windows in the second bedrooms. But interestingly, the building boom is still continuing on unabated. And before the budget, the ABS brought out the latest statistics saying building approvals surged again, and there's no sign of that easing anytime soon, Andrew.
No, but these are fringe houses that are fueling the boom, Michael. Apartment development is continuing to collapse, and apartment development has really almost disappeared. And that just means we've got to push further and further out and look at suiting markets that have the capacity to sprawl, that have those green acre, greenfield type of environments, such as Perth, Melbourne and Brisbane, but not so great for Sydney, that's now already spreading way beyond 60 to 70 kilometres from the CBD, and not suiting everybody to have that type of outer suburban lifestyle, Michael. And as I was discussing before, it has its limitations and it has its negatives. But look, it's a great thing in terms of jobs it's creating, revitalising economies. And I'm certainly not a naysayer in that sense, but we need to be able to match these types of policies and the products they produce with other products for those that are not looking for that fringe lifestyle. And as I said, we're going to see building costs rise, Michael. And once the stimulus packages end, it's going to make it even harder for first home buyers to try to get in the market because they won't have the advantage of the policies. And of course, they'll have higher house prices and building costs to cater.
Well, only yesterday I was speaking with Greg, my business partner in our construction company. We've never been as busy as ever. Yeah. But interestingly, there are a number of bottlenecks. One is trades. Trades are actually having a field day. They can get as many jobs as they want. And so for that reason, they're pushing up their costs, their prices. And also there are supply chain constraints also. Suddenly when you increase the demand, and there hasn't been that in the past, it's actually making it hard for all sorts of materials as well. Again, that pushes up the costs. Yep. That's going to be one of the consequences, as you correctly say. Well, the other interesting thing is there was no nasty surprises in the budget for property investors, but it would be a very brave government who would be tweaking tax implications, negative gearing or other things, especially with an election sometime in the next 12 to 18 months.
Yeah, that's right, Michael. I read a couple of comments from those that very quietly mentioned the negative gearing scenario, and they only mentioned it for a second or two and then moved on, realising that I guess it's common knowledge, or perhaps it's a bit of a theory, that it's electoral poison to touch investors, particularly through negative gearing. But a clear argument to that is that if negative gearing was such a terrible force in housing markets, well, why have we had so few investors in the market over the last, 12 to 18 months, and we've had so many first home buyers? I mean, those that were promoting the nirvana of getting rid of that horrible negative gearing tax relief have certainly got egg all over their face when they look at the fact that investors have fallen in a hole and first home buyers have boomed over the last 12 to 18 months. So it was just once again an ideological claptrap sort of position. And the reality of it has certainly been proved recently. So yes, we don't have any, thankfully, a sense that we need to control the buyer profiles of the market. Again, the supply side is the answer to all this, and we need to start addressing that, sort of all of government type of policy position.
I know you recently brought out a first home buyer affordability report, so I'm going to tease our regular viewers by saying, come back next week in next week's Property Insider video. I'd like to unpack that and get your understanding of what the real story about affordability is. So we'll catch up again this time next week. Thanks, Andrew.
Yes, thanks, Michael. Thanks a lot.